more on the debt ceiling in the market. Let's bring in Julian Emanuel, Evercore ISI Senior Managing Director. Julian, great to have you with us. For all what's going on, the markets, you walked into our green room today and you said the invincible market. Here we are. It is. It seems that way.
It is. Look, so at the S&P 500 level, you have been literally motionless for 7 months now. Now, of course, the concern is that the year-to-date returns are, call it, almost two-thirds driven by those top 5 names, all of which have AI in their remit somehow or another. And that is a concern, particularly when you see the Russell 2000 really approaching its lows of last year. So it seems like it's okay. And frankly, from our point of view, we don't understand why the VIX is as low as it is, given the fact that the T-bill markets a week ago, 1-month T-bill yields were 100 basis points lower than they are now, because that 1 month is now over the X date. Same concern in the credit default swap markets. We think there's a little bit of a disconnect that's likely to get resolved with a little bit more volatility in the coming weeks.
All right, so Julian, you mentioned AI. It does seem to be something that investors are pretty excited about this year. And it's not just one of these sort of mini bubbles that we have seen. You know, when we talk about what we saw in SPACs, if you talk about what we saw in crypto and all these other tech things, we're talking about maybe it's $1 or $2 trillion, you know what I mean, like in totality. But when you think about what's moved the entire stock market, mega cap stock, it seems like all of the risk has been transferred into a handful of names. Is that the sort of thing, as a strategist, with volatility readings where they are right now, doesn't that make you nervous that we could have some sort of snowballing effect if there was something to cause, I don't know, some concern about this bubble where a lot of investors have placed all of their hopes in?
It definitely does, Dan. Look, to us, the AI revolution is likely quite real, quite significant. But as we all know, whether it's the internet or what have you, these things unfold in waves, and you get a little bit too much enthusiasm and the stocks sell off. If the rest of the market was participating, that would be another thing. But that's not the case. And I have to tell you, we've had some very odd conversations the last several days with people who actually think there's an amount of money, it's probably not large, that actually look at T-bills and wonder whether they're safe, look at bank deposits over $250K and wonder whether they're safe, and are putting money into the top 5 large cap tech names.
They're really talking about
safe.
Perception in the markets right
It's
now.
extraordinary.
Fear. When you say too much concentration in the top 5 names, that implies that there will be a run for the exits. That is sort of the danger of that. I mean, if you're investing in the top 5 names, which is probably most of America through passive investing, right? What's going to make me sell? So then where's the instability in the markets? Like, let's say the economy does hit the skids. Where's the instability in the market? So
the instability is, again, as you said, the public continues to be disproportionately exposed to those types of names. But the fact is, and we've been talking about this for months now, and I think it's part of the frustration, we almost want the recession to come to get the clearing event, and we've been talking about it for a year. But the fact is, until the labor market does what the Fed would like it to do in terms of its projections, there isn't going to be any real urgency to sell stocks. So for you, what do you tell clients? Because that's a tough sell to just sort of wait. It's going to come. It's going to come. The labor markets are going to crack. You just wait. You just wait. You just wait. And in the meantime, the markets are sort of motoring along, and your clients are probably like, Julian, you told me to hang on here. What's going on? So our view is that you want to stay in the more defensive sectors. Interestingly enough, with all this AI talk, healthcare and consumer staples have outperformed since April 1st. We think they're going to continue outperforming. It's a good place. Biotech also among healthcare. There's M&A activity going on, and that's a sector that does well when the Fed pauses, and we think they are pausing here.